Welcome to our channel. Let's start right away. Ever wondered what ETFs are and how they work? ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, just like individual stocks. They truly are a versatile tool, suitable for all types of investors, from those just starting out to seasoned professionals. They're like a chameleon, taking on the characteristics of various types of investments. They can as diverse as a forest, holding a wide array of assets such as stocks, bonds, or commodities. Or they can be as focused as a laser beam, designed to track the performance of a specific index or sector. Imagine them as a basket, where each fruit or vegetable represents a different type of asset. When you buy an ETF, you're essentially buying a small piece of this basket, giving you exposure to all of its contents with just a single purchase. Now let's talk about mutual funds for a moment. You might be thinking, hey, that sounds like a mutual fund, and you'd be right to an extent. Both ETFs and mutual funds allow you to invest in a diversified portfolio of assets with a single purchase. However, there's a key difference between the two. While mutual funds are like a daytime soap opera, with all the drama unfolding once per day when they're priced at the end of the trading day, ETFs are like a thrilling action movie with prices changing throughout the day as they are bought and sold on the stock exchange. This provides investors with the flexibility to buy or sell ETFs at any point during the trading day at market prices, giving them greater control over their ganap. Unlike mutual funds, which are priced once per day, ETFs are traded throughout the day at market prices, providing investors with flexibility and liquidity. So, why should you consider investing in ETFs, no matter your age or financial background? There are several key benefits. One of the most significant benefits of ETFs is the instant diversification they offer. With a single investment, you can own a slice of a broad market, industry sector, or even a specific commodity. This basket of assets approach can help spread risk and reduce the volatility of your portfolio. Now, let's talk about accessibility. ETFs can be bought and sold throughout the trading day, just like individual stocks. This means you can react to market movements in real time, offering a level of flexibility that traditional mutual funds can't match. And then there's liquidity. ETFs are traded on the open market. They tend to be highly liquid investments. This means you can typically buy or sell ETF shares quickly and at a fair market price. Cost efficiency is another plus. ETFs often have lower expense ratios compared to mutual funds, making them a cost-effective option for many investors. Lastly, transparency is a hallmark of ETFs. With most ETFs, you can exactly what assets the fund holds on a daily basis. This allows you to understand you're investing in and make more informed decisions. Firstly, ETFs offer instant diversification, allowing you to invest in a basket of assets with a single investment. This can help reduce risk and volatility in your portfolio. So whether you're an experienced trader, just your investment journey, or at any stage of life and from any financial background, ETFs could be a valuable addition to your portfolio. There are various types of ETFs available to investors, each with its own unique characteristics and investment objectives. These diverse ETFs cater to different investment goals, making them suitable for a wide range of investors with varying risk appetites and financial objectives. Let's start with broad market index ETFs. These ETFs aim to mimic the performance of major indices like the S&P 500 or the NASDAQ 100. By investing in one of these, you're essentially buying a small piece of the entire market, providing you with instant diversification across sometimes thousands of stocks. This is particularly suitable for investors looking for broad market exposure. Next, we have sector ETFs. These focus on specific sectors of the economy, such as technology, healthcare, or financials. If you believe a particular sector is poised for growth, a sector ETF allows you to invest in a broad range of companies within that industry, all with a single purchase. This allows investors with sector-specific interest to tap into their chosen markets. There are also commodity ETFs. These ETFs invest in physical commodities like gold, oil, or agricultural products. They offer a way to gain exposure to the commodities market without having to buy and store the physical goods, suitable for those seeking to invest in commodities. Bond ETFs are another type. they invest in bonds, providing income-focused investors with a way to gain exposure to the debt market. They can focus on government bonds, corporate bonds, or a mix of both. Then we have international ETFs, which offer exposure to markets outside of your home country. They are suitable for investors wanting to diversify their portfolio geographically and tap into growth in emerging or established markets worldwide. And lastly, let's not forget about thematic ETFs. These are designed to capitalize on emerging trends or themes, such as clean energy, e-commerce, or artificial intelligence. They offer a way to invest in innovative industries that could shape the future. They are ideal for investors interested in riding the wave of specific trends. From broad market index ETFs that track major stock indices like the S&P 500, to sector-specific ETFs focusing on industries like technology or healthcare, there's an ETF to suit every investment strategy. Understanding the different types of ETFs can help you make informed decisions that align with your investment goals and risk tolerance, making them a viable option for a diverse range of investors. Embarking on the path to becoming an ETF investor? Don't fret, it's simpler than you might imagine. The beauty of investing in ETFs is that it's a process anyone can learn, irrespective of their financial background. The first step towards this journey begins with opening a brokerage account. You can easily accomplish this online with a reputable broker. While selecting a broker, remember to consider aspects such as fees, platform user-friendliness, and customer service quality. Once your account is up and running, the subsequent step is research. This critical phase aids in pinpointing ETFs that synchronize with your investment objectives. Leverage online resources, financial news headlines, and your broker's tools to grasp the fundamentals of each ETF. Understand the importance of the ETF's expense ratio, its underlying index, and its historical performance. Be mindful that past performance cannot predict future results, but it can offer insights into the ETF's volatility and risk level. After selecting the suitable ETF, the last step is to initiate a trade. It involves merely entering the ETF's ticker symbol, determining the number of shares you wish to buy, and hitting the buy button. Remember, while some ETFs can be traded at no charge, others might involve a commission fee. And there you have it. You've successfully become an ETF investor. Remember that investing is long-term commitment. Regular reviews and necessary to your portfolio are crucial to accomplishing your investment goals. Evidently, the process of investing in ETFs is straightforward. Open a brokerage account with a trusted online broker, research ETFs that align with your investment goals, initiate your trade, and you're done. It's truly that simple. Before diving in, it's crucial for all investors, regardless of their experience level, to understand the risks and considerations associated with investing in ETFs. Like any investment, ETFs come with a certain level of risk. One such risk is market volatility. This refers to the rapid and significant price changes that can happen in both directions within short periods of time. If the market experiences a downturn, the value of your investment could decrease as well. Another risk to consider is tracking error. ETFs aim to replicate the performance of a specific index or sector, but sometimes there can be a discrepancy between the ETF's performance and that of the index it's tracking. This discrepancy is known as tracking error, and it can impact the return on your investment. Liquidity is another important consideration. While ETFs are generally considered to be liquid investments because they can be bought and sold throughout the trading day, some ETFs may be less liquid than others. This could make it harder to buy or sell shares without impacting the price, especially during periods of market stress. Lastly, it's crucial to remember that past performance is not indicative of future results. Just because an ETF has performed well in the past does not guarantee it will do so in the future. While ETFs offer many benefits, they are not without tenets. Factors such as market volatility, tracking error, and liquidity can impact ETF performance, so it's essential to do your due diligence before investing.